I started my investing journey several years ago, shortly after I started earning a full-time paycheck as a working adult. I had zero knowledge of investing and I didn't know what I didn't know. Where do I start as a beginner? What kind of questions should I be asking? What type of investments are suitable for me? I went around learning from different sources, pulling bits and pieces of information together and trying to make sense of the bigger picture for myself. In an earlier video, I shared this journey from how I came across the different aspects of the investing world and my biggest investing mistakes to my investing plan. Since then, I have picked up even more knowledge of investing and I believe that I have finally landed on an investing style that suits me best at my current life stage and that is aligned to my investing objectives. It's been a learning journey of 7 years. 7 years is a pretty long time, I would say, to finally land on this. Time is of the essence when it comes to investing. I wish that several years ago I had all the knowledge I have right now because then I would be closer to my financial goals than I am today. I will update how my investing plan has changed towards the end of this video. First, I want to talk about what I wish I could have changed knowing what I know now. Bear in mind that the things I will be sharing are based on my risk tolerance, life circumstances, and investment objectives. This is not a recommendation for you to do the same because your risk tolerance, life circumstances, and investment objectives may not be the same as mine. At the beginning, for a good 3 years, I was invested in bonds and exchange-traded funds. Bonds are issued by governments and corporations to raise money. When you buy a bond, you give the issuer a loan. They in turn pay you back the face value of the loan at a future date and pay you interest periodically along the way. ETFs are a type of pooled investment security that holds multiple underlying assets rather than only one. Because of this, ETFs provide diversification in an investment portfolio. For bonds, I invested in Singapore government savings bonds and a bond fund. For ETFs, I invested in those tracking the Singapore market, Singapore-listed REITs or real estate investment trusts, and the international stock market. I adopted a passive dollar cost averaging approach to investing in ETFs. There is nothing wrong with this approach. I had exposure to bonds and equities locally and internationally. It's passive, easy, and I was doing what I knew and felt right to me at the time. However, in hindsight, it wasn't aligned with my investment objectives to build wealth, because bonds help you to preserve your capital rather than grow it, and ETFs give you average market returns. As someone who was in her mid-20s without dependence back then, I could have taken on more risk for better than market returns. And as I learned over the years, as long as I am invested in the right assets, I can sleep comfortably at night even if there is market volatility. So if I could do it differently, I wish I had invested in stocks of high-quality businesses because they tend to give above market returns over the long run, especially when they were undervalued at the point of investment. Undervalued refers to when a stock is trading at a discount to its intrinsic value. This reflects the principles of value investing, which I only started adopting 3 years into my investing journey in 2021. If I had done that from the start in 2018, my portfolio value would be significantly higher than it is today. To give an example, assuming I invested $10,000 into VWRD from 2018 to 2021 and then immediately took the capital and proceeds to invest into Apple from 2021 till today, I would have an overall 46.16% gain. Assuming I invested $10,000 into Apple over the same time period from 2018 till today, I would have a gain of 190%. Comparing both scenarios, I actually missed out on a gain of 143%. In 2021, with the low interest rate environment, a very bullish US stock market, and a lot of frenzy around certain stocks popularized on social media, I bought into the hype and invested about 15% of my capital into some of those stocks. I didn't do my due diligence, wasn't using my judgment, and was acting on the fear of missing out. Deep down, I knew I was risking it, but I went ahead anyway and invested in something I didn't know well enough. Sure enough, when the 2022 crash came, these stocks plunged in value several times more than my other investments did. I wish I had never gotten involved with those frenzy stocks. But something else that I wish even more that I could have done differently was correcting my mistake by humbly taking a loss. Although I acknowledged that it was a mistake, I actually held on to the paper loss for a good 2 years until recently. Psychologically, I couldn't realize the loss. But logically, cutting the loss and redeploying the capital into higher quality investments would have been the wiser thing to do. Because if I had corrected my mistake and reinvested whatever I had left into undervalued, high-quality businesses during the 2022 crash, I would have been on my way to recovering my capital. One of those stocks that I invested in without doing my due diligence was NIO. I lost 88.6% of my capital on this stock when I exited my position in April of 2024. If I had corrected my mistake earlier, even at the worst of the 2022 crash, and exited with a 78.7% loss, and then reinvested whatever remaining into high-quality businesses like Apple, I would have gained 14.8% of whatever capital I had left back then. Because I didn't correct my mistake earlier, I had to realize an even bigger loss of 88.6% and missed out on recovering my capital earlier. I'm not saying that NIO is or isn't a good business or that the price will never trade back up. It's just something that I didn't understand well enough when I invested in it. Whenever I had available money to invest, I would want to immediately plow it into the stock market. This made sense during some periods of 2022 and 2023 when the stocks I was interested in were trading at discounts to their valuation. When the stock market started to recover to previous highs and stocks started to become more expensive, I grew impatient and somewhat afraid that I would miss the opportunity to invest and would have to sit on too much cash until the next opportunity came, which could be months or years later. Having too much cash beyond the money set aside for living expenses, emergency fund, and short-term financial goals means that I am losing out on opportunities for my money to grow at a higher rate than the rate I could get outside of the stock market, such as bonds, fixed deposits, and high-interest savings accounts. In those times, I would invest into a stock as long as the price was trading at fair value, even though it was not at any major support levels. Support levels are areas where demand is strong enough that a stock may stop falling and may bounce back up from this level. This is mainly used in trading, although I use it to make entry decisions in my investments as well. Well, unless my patience gets the better of me. When it comes to value investing, the lower you can get in below the intrinsic value of the stock, the better, because then you get a wider margin of safety. However, I also came to understand that great businesses don't trade at discounts to their valuation for long. So there is a need to balance between getting a good discount versus missing out on an opportunity altogether if the price moves up too fast. My fear of the second scenario made me impatient too frequently. Because of this, most of my entries were at fair value and most of the time, price would retrace further to support levels before bouncing back up. I missed out on getting in at more attractive levels and getting a bigger margin of safety. I also missed out on getting more shares at lower prices because I have no more cash to deploy. If I could do it differently, I wish I had been more patient. Instead of deploying any available cash I have the moment the stocks that I'm watching reach their fair values, even when the technicals on the chart may not make any sense, I could have waited to enter at a level with strong technical support below the fair value. That would have made a difference to my long-term portfolio performance. A recent example is the case of Apple. I was building my position in Apple, but the stock has been trading above my intrinsic value calculation for the most part of this year thus far. When it eventually traded down, I entered right at intrinsic value even though it was still above the support level I had identified. Sure enough, it traded down to my support level a few days later and I ended up kicking myself for my impatience. Although it's only a $3 per share difference, it can add up to a lot if the position is big, and when we consider the impact of the return over the long run. The last time I shared how I was investing was about 6 months ago. In the past 6 months, I learned more about value investing and planning for financial freedom. As I gained more knowledge, I gained more confidence. The plan I had before has changed, and this is how I am investing now. I am investing for two purposes, growth and income. The objective of the growth portfolio is to build my wealth. This portfolio consists primarily of stocks of high-quality businesses listed on the US stock exchanges, such as Apple, Google, and Microsoft, and a small percentage in US ETFs tracking the S&P 500 and Russell 2000. Why the US stock market? Because it tends to offer the highest investment returns over time compared to other markets. Looking at this article from Markets Insider, the share of equity market capitalization relative to GDP has grown in the US faster than most of the world. The other part of my investment portfolio is to invest for income. The objective is to generate dividends to fund my living expenses alongside other streams of income. This portfolio comprises dividend-paying stocks listed on the Singapore Stock Exchange, and I invest primarily in REITs or real estate investment trusts. I don't invest in the US for dividends because, as a non-US resident, I am subject to a 30% withholding tax. Conversely, in Singapore, I am not taxed for dividends received. As for overall portfolio composition, my plan in this phase of my life is to have about 80% of my investing capital in my growth portfolio and 20% in my income portfolio. As I get closer to my target retirement age, I might allocate a higher percentage towards my income portfolio. It took me several years of trial and error to finally land on an investing style that suits me best at my current life stage and that is aligned to my investing objectives. Although I enjoyed the process of learning and exploring, I wish I could have done certain things differently earlier on. I wish someone had sat me down and talked to me about investing, the different approaches, principles, and practices to adopt and to avoid. If you're starting out on your investing journey or still figuring out your way to find the style that best suits you, I have put together a list of resources that anchored important investing knowledge for me. If I could give guidance to my younger self to help her along and find her way in the world of investing, this would be it. Check out the list of resources in the description box.